Okay, let me break this down. So Humana just crushed Q2 earnings, right? Exceeded revenue and EPS expectations, maintained their 2026 profit outlook, but their stock still dropped 6%? Wait, what? That seems backwards. Why would the market punish a company for delivering solid numbers? Let me tell you why this paradox is actually way more fascinating than it looks at first glance. First off, the headline numbers, $7.61 EPS versus $7.22 expected, $40.87 billion revenue beating $40.61 billion. Their medical cost ratio was exactly in line with forecasts at 91.2%, which they're spinning as stability. But here's the twist. The analysts at Cantor Fitzgerald called keeping their profit forecast unchanged a disappointment. That's the key. In an industry where competitors are raising guidance, standing still feels like moving backward. Personally, I think this reveals how investors are now treating healthcare stocks like momentum plays. It's not enough to meet targets, you have to constantly raise them. Now let's unpack why medical cost trends matter more than the raw numbers suggest. The CFO mentioned slight favorability in inpatient costs among value-based providers. What this really signals is the beginning of a sector-wide reckoning. Insurers are finally starting to crack the code on cost management through network optimization and outcome-focused care models. But wait, pharmacy costs are still skyrocketing because of specialty drugs like GLP-1s. This duality fascinates me. It shows the industry is winning small battles on traditional care, but losing the war against farmer pricing power. Here's what most people miss. That 91.2% medical ratio is actually worse than last year's 89.9%. A lower ratio equals more profit, remember? So while they're claiming stability, they're quietly paying out more in claims than before. The real story isn't about this quarter, it's about 2027 and 2028. Their plan to hit 3% pre-tax margins by 2028 through membership growth and quality ratings? That's a Hail Mary pass in Medicare Advantage. Why? Because quality ratings are increasingly tied to tech investments and member experience, which require spending now to save later. Short-term pain for long-term gain? The market hates that calculus. Let's zoom out. This earnings report isn't just about Humana. It's a window into the existential crisis facing all Medicare Advantage providers. Post-pandemic care backlogs, aging baby boomers, and $90,000 a year weight loss drugs. They're creating a perfect storm of rising costs. But Humana's approach, expanding CenterWell clinics while tightening pharmacy benefits, reveals a deeper strategy: vertically integrate or die trying. It's Amazon Prime Healthcare meets drug cost warfare. Will it work? Maybe, but only if they can convince seniors to change decades of healthcare behavior. So here's my final thought. Why are we surprised when the stock dropped? The market isn't reacting to what Humana did. They're reacting to what they see coming. The real question isn't about this quarter's numbers, but whether the entire Medicare Advantage model can survive the next decade without major structural changes. What do you think? Is Humana's hybrid insurance or provider model the future, or just another band-aid on a broken system? Drop your takes below.